Hello, everybody, for your mid January edition of The Officials. The world is moving. It's so fast, everything. And we have a good show for you with three of my colleagues, Ed, Will, and Martha, who will give us a view into the weather in the US, in Europe, and how is that affecting demand. But let me give you a little bit of a broad view of what is happening in the markets. As you may have noticed, we went a little bit bullish in mid-December, and we were not expecting to be as successful as we have been in our call that predicted higher prices. We raced towards the $80 level, and we have surpassed it quite comfortably, hitting a little shade above 82, and then now we are consolidating around 81.50 as we speak. So what has happened? Well, a lot has happened. But the most important thing occurring in markets right now is what I would say is an acquiescence to the US and a fear of the US. Everybody is looking at Trump coming in on January 20th, and Biden is heading into the sunset, and he's moving and doing a lot of things. But in the marketplace, they think that they're just the pre-Trump moves. So Biden is not getting any special recognition for everything him and the State Department are doing ahead of Trump coming in. But everybody is afraid of sanctions, is afraid of tariffs, is afraid of disturbances in the physical world. So what we are seeing is that prices essentially jump by $10 a barrel from the low 70s to the low 80s. I just had a meeting with some people in the industry, and we were doing the numbers, which $10 versus roughly $100, 100 million barrels of production per day mean an extra $1 billion of cost to the world. Those numbers are, in a way, terrifying, that the world is losing $1 billion at a time per day, at a time that the world economies are not doing so well. But everybody's in a mood to acquiesce to what Trump may do. There's a lot of tariffs on expected to arrive as soon as he comes in. The Canadians are getting ready for a 25% tariff even on crude. And China is very afraid of busting the US sanctions that prevent some of the dark fleet to discharge oil into their ports. They're sovereign nations, so I don't know why they're so afraid, but the fact is they are afraid and reacting as if they were a vassal state. They make their decisions, so be it. Because of these decisions, all the buyers have gone out to buy any other crude or any other vessel that is legal under the US terms. And this means that China and India in particular have rushed to buy any oil available. Traders in Asia tell me that the Indians Thursday and Friday came in and bought what was available in West Africa and other locations. So everybody's scrambling for oil that will beat the expected and current US sanctions. And this is leading to a very high price. So I would like to pass it on to my colleague, Will, and then to Ed, to talk about what has happened to the premiums for Dubai-related crude in the past 10 days. It has been awesome because today we're almost close to $5 premium. We essentially passed 4 and we're heading into very stratospheric territories. But guys, if you could share with us what you have heard.
For sure, Jorge. And as you say, the premium today particularly has just been stratospheric. A month ago, we were talking about premiums of about $1. The average in December was $1.08. And then in the last few trading days, they've just skyrocketed. So on Friday, they got to around 350, then 375. Yesterday, 377, and we thought, okay, that's high enough. But today it gained again another dollar almost. It's at 470, and that's the highest we've seen since we started doing the officials. We posted a chart of our 6 or 7 months of premium Dubai physical premiums, and it's just it's straight up effectively. It's hit a wall. So you can go and see that on our new Twitter page, and so the structure is incredibly strong, and the real winner seems to be Totsa because they've bought so much of the crude from the Dubai window on the spot market. They bought 35 convergences in December, and they got most of those when the premium was down around 90 cents to a dollar. And now we've heard they're selling them on to particularly Chinese buyers. So, for instance, Sheng Hong, Rongsheng and Sinuk both apparently got a VLCC of Upper Zakum or Oman, and they've apparently been paying February Dubai swap plus $2.50. So if TOTS has bought most of this crude at, say, about a $1 physical premium, which remember is the physical over the M2 swap, they're making a massive profit on every single barrel that they're selling on. So yeah, TOTS has played the field and they've done incredibly well out of this. And
let me interject a little bit there. Yeah, they have done very well, and hats off, Totsa. You saw it coming. Everybody is wondering why Totsa had such a good call. Was it luck? Was it a skill? Well, we all know Totsa for many years, and they're very skillful people, and they make decisions sometimes based on what governments are saying. And there have been a few leaks by governments in the past 2 weeks at least. And those are things that under any other circumstance could lead to some insider trading, really, because the document outlining the sanctions by the US, which were implemented this past Friday, were in the hands of the traders as early as Wednesday that I talked about. And I couldn't believe that, right? Because a government, when they implement something, they should do it without any prior notice to anyone. So that was very disturbing for me as an observer of markets. And I also understand that US government officials have been visiting trading companies to inquire about balances and what would happen if sanctions are imposed that prevent the movement of certain vessels. And that again leads to some kind of insider information where then the traders, by definition, upon hearing this, they're going to go out and buy and do what they have to do. We cannot blame the traders from acting from information that is being released by a government. So who are the winners in this situation? As Ed was indicating there, prices went from 1 to nearly 5. And we shouldn't forget that Murban already exceeded a $5 premium. This is unprecedented in recent history. It's huge numbers. So who are the winners? Not just the traders. We have been talking about Totsa. There are many others that have gone long. I have spoken to them, and they're very happy, very pleased with themselves, having drinks, enjoying their life because they called that right. And of course, the US government helped them call right. But the other winners in this are the national oil companies. I have also met with people from the Middle East in the past few days, and they are happy because, as one of them was telling me in the past 48 hours, well, prices were 70, now they are 80. Our leaders are breathing in relief because our budgets are looking good again. So who gets it on the nose? The consumer again. So our leaders are doing things for political reasons, but not for reasons that are good for us as citizens, as people that have to pay taxes and pay tariffs. But hey, we're subjects at the end of the day. So I don't know how you guys feel about it, but I think there is a sense of happiness in markets because traders, by definition, are kind of long. one other thing that I kind of am foreseeing is that the prices, the differentials for dated Brent are going to explode because Asia has bought so much crude that is dated Brent related that is leading to Europe being a little bit of short of crude, and they're going to have to bid up dated Brent to make up the shortfall. I am now overly focused on Asia, so I lost a little bit of track of what is happening in Europe. So I don't know if one of you guys want to tell us what is happening there in the windows and with dated Brent. That would be extremely useful.
Yeah, well, the window in the North Sea window, for instance, is active, but it's not exploded into life in the same way as the broader market has. And I think part of the reason for that is the freight cost. I think because much of the price move has been motivated by these sanctions on vessels, freight has just roofed. A lot of the major routes are up 25, 30% from a week ago. So the possibility of moving European grades around to Asian buyers, who are clearly the ones who are getting hit on the nose, isn't perhaps as open as some would hope. And I think that's really a big cause behind the distinction between Brent and Dubai grades.
We are still seeing a lot of action from your Petro Ineoses
Yeah.
in the window, so they're still
for
scooping
sure.
up 40s. So they're clearly not too dissuaded by the freight costs.
Fair point.
I wanted to add that we have seen Unipec selling Dubai, which into Totsa, which has resulted in actually those prices being lower in the past than they are now. But sources were telling me today that Unipec may have lost money in Dubai trading, but has made a lot in shipping because they were very quick in chartering some ships that have now gone in value quite a bit. So traders, move very quickly. Sometimes they lose here and make money over there, and that's the way it goes. Will, how are things looking economically in Europe?
Well, in Europe, very little change, to be honest. Still pretty gloomy. We had factory orders in Germany print at minus 5.4% the other day. And we're just getting the continued string of poor economic prints, really. UK GDP was at 0.1% today for November. That came out today. But we've interestingly had a lot of action in sovereign debt markets yesterday. Last time we recorded, we were talking about the increased borrowing costs for the UK government debt specifically, but also the Treasury. And we've seen a bit of a change there, because we got the US CPI print, which came out. The headline figure came out as expected at 2.9%. But the core measure, which strips out energy and food inflation, came out at 10 bits softer than expected. The reflation trade that had been driving the bear steepener in the Treasuries curve and the higher yields across global sovereign debt markets started to be unwound a little bit. We saw some short covering, so everyone who was selling government bonds raced to buy those shorts back. So the 10-year gilt shed about 20 basis points yesterday at its most extreme move.
I am so excited about that. Only 10 points. But at least the equity markets jumped, right? The equity markets really did well in the UK in the past couple of days.
Yes, for sure. Because we'd seen a lot of that capital flight before, and the reassurance that came from people unwinding those short positions will inspire a little bit of investor confidence, I'm sure. But the 10-year US Treasury also shed 16 basis points. That's going to affect people's mortgage refinancing rates. It's going to affect a lot of things. And the market is now expecting 38 basis points of cuts from the Fed next year. After, at the start of the week, they weren't expecting any cuts from the Fed. So we're having a bit of an adjustment in terms of how the market's pricing inflationary pressures over the coming year. But really nothing material, in my view at least, has changed. The fiscal irresponsibility that sent yields rising is still there. In the first 3 months of the fiscal year, the Treasury, the debt taken out by the Treasury was up 39% against last year to over $700 billion. And the ISM Services PMI printed at 64.4 in December. That's up from 58.2 in November. So the inflationary pressure is still there. So globally, I think the dollar will probably remain pretty strong, if not strengthen further. And naturally, that will hurt the purchasing power of foreign crude importers. So I think really we're unlikely to get much of a positive oil demand impulse from any monetary easing in the US for a while.
Yeah, let me interject here. So what we have is a market where governments are issuing so much debt and they need to borrow that money, which causes interest rates to rise, and then that slows down the economy. As an economy slows down, the price pressure eases, and therefore maybe inflation it gets better on a nominal basis. Some people here in Asia are expecting that the oil market will physically be long in March and April due to the upcoming turnarounds and because of the slowdown in the economy. But in the meantime, they're buying it hand over fist. And that causes the flat price to go up, but the actual demand from the consumers is not rising. So it's really a fear-driven price. And talking about fear, there's a lot of fear also in production being affected because of, and here comes Martha, because of the weather. Martha, please share what you have learned with us.
Of course. So at the beginning of the week, we started seeing some kind of like warning signs about some extreme weather coming the end of this week and into next week. And the thing about longer range weather forecasting is kind of obviously the further you're away from the event, the less kind of accurate it is. So right now we're looking at between 3 to 5 days and 6+ days out from the event. Still looking at the models and taking into account the different parameters, it's still too low in confidence to make decisions about what definitely is going to happen. But starting from the start, we can see the Texas, focusing mostly on Texas because that's where we'd like to think of the oil infrastructure. There is an air mass from Siberia and then Arctic and Canadian air as well, passing down into the lower 48th with strong Canadian pressure, and it's been called the Siberian Express, which I think is fun, and is going to crash into the Rockies, which could potentially funnel it down into Texas, which could be a massive, massive impact. We're looking at, when you're looking at these temperature differential maps, there is this huge purple mass over the whole of the state, which is very, very worrying. I think we were speaking earlier about the impact of the February 2021 freeze.
Is production going to be cut in gases or crude oil?
In my opinion, I think that the weather will be cold enough to cause production issues and infrastructure issues, pipeline issues. I think that heating oil, there's room to, that we could see some good strength there. And we're already seeing this strength kind of being built into LNG prices. So like Henry Hub in the States, that's had lots of kind of, with the thing with weather forecasting is because it's not a certainty, well, nothing is, you do kind of get the buy the rumor, sell the fact. So if the storm isn't as bad as people are forecasting, or if it does skew, east or anything that could be forecast, or it doesn't move down in this clump of cold air, we could see prices that have built in this massive freeze because of all the fear mongering by me, then this could sell off in heating oil and in LNG. But yeah, I think it's a definite thing to, I don't want to say it's certainty, that's no good. But no, I think it's highly, highly likely we're going to see some damage to infrastructure.
So if we look at it high level, we have a fear of sanctions, which is causing a price rise. And we now have a fear of actual temporary cuts in production in Texas, which is another bullish element to it. So what are the chances we're going to come down below 80? Or are we going to remain more in the 80 plus? Ladies and gentlemen, any ideas?
Well, yeah, I think we've got a number of relatively temporary bullish factors, weather and front loading ahead of potential currency debasement, and also, like you said, a lot of Chinese buying of Dubai. But I think a lot of that might start to roll out towards February time as China goes on holiday for the Chinese New Year. We might see a slowdown of purchases there. Also, if it is all going into storage, if China and India are building inventories, that can only happen for so long. You need the fundamental demand to justify the crude purchases eventually. So if we don't see an improvement in the macro picture, I struggle to see how long this prompt demand can be sustained for.
I would like to add on the subject of sanctions as well, that a port in Shandong, which was one that said it would not take any US sanctioned vessels, I did hear a rumor that they'd taken a vessel from Russia that had been sanctioned. So they're already trying to filter through the cracks and find the weak points in the sanctions wording where they can circumvent. So the sanctions effect, I think, as well, will be temporary. It might last a few weeks, months maybe, but it will gradually filter out as the dark fleet kind of works its way around.
Yeah. By definition, the higher the price is, the greater the incentive to find a workaround. That's how markets work. Martha, on your side, what do you see coming in the future?
Yeah, I can't help but agree with the temporary nature of the strength at the moment. I think people would more likely than not maybe not want to risk being short over the weekend ahead of the inauguration. I think that we might see some length being added from that, and maybe that being built into the strength in the week. I think that if on Monday we're seeing actual sanctions on Canadian oil and gas, I think there's going to be hell to see. I think there's all hell could break loose, and then if that doesn't happen, there might be an exhale from the market and we might see these spreads soften. We might see people kind of take a breather there. But I think that, yeah, it's just all eyes on Monday, really, isn't it?
Okay, so bullish markets at least through Monday. And here from Asia, we want to wish you a Gong Fa Chai, a happy Chinese New Year. And our friends from the SGX also gave me some red packets. If you know what this means, is they give you an empty envelope, and then you're supposed to put some money in and give it to your relative. And so I am supposed to give some money to my relatives here in Singapore, where I have many. So SGX and my other friends just made me a poor man. So with that, happy Chinese New Year. Thank you, everybody. Trade well and be ready for the day after on Tuesday. We'll see what happens. Thank you very much, everybody.
Thank you.